great to see everybody here. The conference has got off to a fantastic start. Excuse me. We've already answered some of the questions that I wanted to have, which is about, what sustainable finance is. So I think we can move fast on to getting really into the weeds of this conversation. We have with us the chairman, the financer, and the founder here. We have Terence O'Rourke, chairman of not one but two major Irish companies, the utility ESB and the board of the public broadcaster RTE. We have, he's also, we'll take up all the panel if I go into everything that everybody's done, but he's been a managing partner of KPMG Ireland and a former chair of Enterprise Ireland, among very many other board memberships. We have Karen Fang here, who is Managing Director and Global Head of Sustainable Finance at Bank of America. She's a former Managing Director at Goldman Sachs, and her job, very small job, is to drive Bank of America's goal of mobilizing and deploying $1.5 trillion in sustainable capital by 2030. So I think you can agree with me that that's a challenge. She's also co-chair of the Finance and Infrastructure Task Force of the B20, which is the G20's dialogue forum with the global business community. And we have Kaidi Rousselep, who is Impact and Venture Partner at Venturewave Capital. Kaidi founded VentureBeam, which is a platform to connect global startups. She's also a member of the Digital Council of the President of Estonia, her native country. She's a former CEO of the Nasdaq Tallinn Stock Exchange, and she was her country's first IT lawyer. So I think you can agree we've got tons of expertise here. So let's dive right in. I'll just throw this out to the panel generally. How much of a priority is sustainable finance for the business community, for businesses, companies, banks, tech companies? Who's in the driving seat, and is it really taking off? Who wants to go first?
Yeah, obviously it's a key issue. I mean, there is an incredible amount of capital required to achieve the net zero by 2050, and there's a huge amount of capital to be deployed, and it's got to be done very quickly, very fast, very innovatively. And that's now not if it's like we all think it's a good thing to do, but now the regulations are saying you got to do it. So it's just a huge issue on every company's agenda.
So it's a priority, but is it actually, are people committed to it, would you say?
People are committed to it, and I think, first of all, thank you for having us here. It's a fantastic turnout, and really a privilege to be here with this panel. I think it's absolutely happening. I would say it's happening at a pace that maybe people didn't even expect it to happen at. Last year, climate finance globally reached just under $2 trillion. Wow. And this number was $600 billion in 7 years ago. So we're growing at 25% CAGR at such a big number globally. When you think about it, it's a pretty phenomenal thing. And we need $3 to $5 trillion according to the UN. If you talk to McKinsey, they say we need $9 trillion for the net zero transition. So clearly we're not there yet. But 25% CAGR, if you do the compounding, I am the banker here, if you compound it, you will reach $5 trillion in just short 5 years, right? But clearly, we just heard about geopolitics, supply chain disruptions, cost of capital, inflationary pressure isn't easing as fast as we'd like, right? The cost of capital compared to a few years ago is still dramatically higher. And a lot of geopolitical tensions are going to make things slower. Permitting, reforms, regulation, policy is helping. But I think the uniformity of it, the consistency of it is really important across the globe because we do have a global supply chain. So there are challenges to get there, but it's absolutely happening. And it's happening in the industries that you would expect. Renewable energy, we talked about wind and solar, we talked about storage, we talked about EVs, transmissions, grids. Those are the usual suspects. We're starting to see much more, I would say, impact or venture and private equity investments into newer technologies. We heard people ask about carbon capture and sequestration. Obviously, the e-fuel space, whether it's green hydrogen or e-methanol, sustainable aviation fuels. And then you start thinking about the global infrastructure in terms of other cooling, energy efficiency. There are a lot of technologies that really need a lot of funding. Some of them are electric planes, we just talked about that. So all of these are starting to get funding. Globally, it's probably still under 15%. So out of that global net zero dollar number. So we still need to see emerging technologies get more funding because according to the International Energy Association, half the technologies that we need for net zero is not yet mature yet.
Yeah. And from the venture capital point of view, I mean, we're all sitting here because of Venturewave capital, right? So it's impact investment funds, and yesterday, those who saw the portfolio companies, everybody not only does good, but returns quite substantially on the investment. But one interesting thing, when you Google or when you search, for example, TechCrunch, which introduces the latest tech news, and when you go and press the tab of funding, you see the latest funding in venture industry, and specifically when you see the new announcement of venture funds, majority are impact funds, investing in education, health, even autism, and all these different sides. So venture capital and venture money is going into impact and impact companies. So I think it's not just the full speed, actually, but it's because capital so much drives the change. It's happening, and it's full speed.
So there's plenty of money around. Everyone's on board with the idea that we need to be investing in all of these different areas, and as you say, Katie, broadly, not narrowly. What kind of returns can people expect? What's in it for investors?
So I would say the returns, when there is a business case to be made, the reason that we firmly believe at Bank of America, this is a business opportunity, because all of our clients are doing it. Every single industry sector, people are trying to implement lower carbon technologies, lower carbon solutions across their 3 scopes of emissions. If you follow greenhouse gas protocols, and you would know, what you should be doing in your own operations, energy efficiency, your EV fleets, and what your electrified equipment for heat and cooling, et cetera, your scope 2 in terms of your renewable energy supply, instead of just pulling it potentially from the grid or greening the grid, we all have to do that together. And scope 3 is much larger in terms of a challenge, because obviously that involves the entire value chain. So when you think about all of the clients across industry sectors, obviously we talk to thousands and tens of thousands of small businesses as well, thousands of large companies, and tens of thousands of small business companies. When you look at what they are doing, when things that make sense from a business perspective, the financings and the investments are on market returns. When there is, as we discussed, whether it's emerging technologies or certain projects in emerging markets, the returns aren't sufficient because the risk factors are just more and more complex, then perhaps you're not getting market return, but that's when we start blending the capital with governments and philanthropies and multilateral development banks and DFIs to actually start making that return commercial for the different parts of the capital structure. So I would say it is not concession. It is not, charitable. Most of the stuff, when you think about, Katie's absolutely right. Obviously, this is not just about climate, right? The 17 SDGs are both climate goals and social goals, and just transition is an expression of the combination of the two. Things that make sense, like solar plus storage, that's happening at market returns, right? And that's your typical debt returns, equity returns, mezzanine returns. But when things are lacking that business case, because it's still expensive, there's a green premium, that's when the blending of the capital is necessary.
A couple of numbers also to add. If you think about the investment return of your portfolio, what's the average yearly return? If you think about, Morningstar introduced a report on sustainable funds yearly returns. The average global yearly return is 11%. Top performing sustainable funds are returning 23-24%. If this is not a return, then what is return? And that's a report of September 2024.
So the numbers do speak for themselves and make the case very, very eloquently. But is there still is there still any suspicion of sort of greenwashing, that this sounds like a very fuzzy term that's all the rage, and so, yeah, I'll get into that because I should be seen to be doing that. Is that something that is a danger or a problem?
Yeah, sometimes you do. I mean, as those of us who have sat as maybe trustees of pension funds and all the rest, and you go and talk to investment advisors, and 5 or 10 years ago, they were saying, well, you could do this sustainability thing, but you're not sure about the returns, and people would be worried about what's called their fiduciary duties as trustees. You've got to maximize the return for your investors. But I think that debate is over now. I don't see those conversations happening. I think people now just accept the facts that Karen and Katie have said, that there is now loads of evidence to show that there's a good return on these products. And I also think that the regulatory side, this greenwashing issue, the EU, the CSRD, and other things are happening out there in terms of getting people to measure things properly, to be held accountable, to be audited, and all the rest. So I think that issue of greenwashing, if there is some there, it will decrease significantly, because this is going to be a very disciplined process and a very disciplined reporting.
Is it a young person's game? And the other question I want to ask, sort of allied to that, is it a way to also achieve diversity goals by promoting? We have 2 women on the panel here, but to make business more diverse.
Well, on the age matter and the, I don't think, because if we look around the audience and thinking about the age, we are very diverse group of audience, and we're all interested in impact matters, and not only interested. This group of people here are actually investing in impact matters. So we can feel it, we can see it, we can sense it. But on the diversity matter, this isn't a matter for me. Which I can get quite heated, but actually a question to all of you, who are active investors? Please raise your hand. Okay, quite many. How many female founders are in your portfolio? All right. I think that confirms the point that last year, based on Atomico's State of European Tech, 3% of all venture capital went to female founders, less than 20% to diverse founders. And if you think about it, then it is about accumulation of wealth. And if we don't invest in female founders, and if we don't look diversity in teams, then how do we actually diverse wealth, and how do we keep the diversity globally? And also thinking about being a founder or ex-founder, and we do have a diverse team, and we had a diverse team, and not only based diversity on the gender level, actually, but also on different nationalities, different religion, and all of it. And it's so vibrant team, and your clients are diverse clients, your company's clients are diverse clients. So this is a matter actually to think of, and if there's an ask from my side to you, and also from Venturewave Capital side to you, invest next 12 months at least to one female-founded company. You're not only doing good, but I can guarantee you will have a good return on the investment, because statistics prove it.
That out. Terence, I wanted to ask you specifically, as you know, you have so much expertise in the Irish market. Ireland's obviously a major financial centre.
Yep.
How's Ireland doing, and what are you seeing that's working and what's not working?
Well, I mean, Ireland very clearly said sustainable finance is something we can be leaders in. And it is the government of a strategy which would have been originally the IFSC strategy, the International Financial Services Centre, getting FDI in the financial services space into Ireland. The number one theme in the current strategy, and it's called Ireland for Finance, issued by the government, number one theme is sustainable finance. And that's led to things like, for example, at the moment, the Irish Stock Exchange, Euronext Dublin, is the number one global hub for ESG bond listings. It was over 1,400 sustainable bonds representing about 160 billion euros. So it's the number one hub in the world is the Irish Stock Exchange for listing of ESG bonds. Our insurance companies have got carbon neutral or net zero commitments. Our pillar banks are actively active in sustainable finance. We have lots of asset managers in Ireland managing considerable investment, sustainable investment. So Ireland is seeing that the things we did well, and the IFSC was a very successful project 30 years ago. And now we're saying, well, to build on that, we need to get into the sustainable finance area, and they're doing very well on that at the moment, I think.
Is there a difference, and maybe Karen, you can just speak to this with your transatlantic expertise, is there a difference in the way regulations operate in the EU and the US?
I do think there is a difference, and I think in the EU and the disclosure rules regulation, is extremely important. That's sort of in the US we call it the sticks-based approach. In the US we tend to focus on a little bit more on incentives. If you look at the Inflation Reduction Act, which is probably the largest climate legislation passed in the United States history, that has spurred over $400 billion of clean energy investments just under 2 years. So when you think about the approach is different, but the results are similar, right? And when you by the way, it's super refreshing to hear, at this stage in terms of this is not a debate. The narrative is very clear, the direction is very clear. In the U.S., I think we have to be honest, there is a little slightly murkier in terms of narrative, in terms of politicized agenda. When we think about these opportunities, and we're seeing every single day frontline advising clients, big public companies, private companies, small businesses, everyone doing their part. And when there is a business case, when the money makes sense, the returns make sense, people are doing it. So that's why we're seeing this tremendous amount of momentum, I think spurred by regulation, a lot of great regulation. Sustainable finance taxonomy, by the way, is what we based our Bank of America sustainable finance taxonomy on. Obviously, we mixed a lot of different great ingredients from other second-party opinions, Sustainalytics, S&P, but that was the backbone of our taxonomy, and guided by the 17 UN Sustainable Development Goals. So that's been tremendously helpful. So once you have a framework, you have guardrails, and you have incentives, all of a sudden, those technologies that don't make business sense today, they don't break even today. It's not like solar plus storage. All of a sudden, they can be bankable because you are taking care of 25 to 40% of the capital structure in terms of capex cost with these tax incentives that the US government is giving you, right? That's not just for the US. We see a lot of European companies building factories, maturing the technologies in the US, because I do think there is a global benefit of increasing the supply, start turning the flywheel faster and faster, driving down the green premium, so we can adopt these technologies more broadly. So I think it really is a different approach. We really do see this being very different, but we were the beneficiary of both approaches from the EU and the US, and the more the merrier.
Very good. Well, I want to ask one super quick question before we probably have a couple of minutes and not much more for questions from the audience. But one super quick question. AI is very topical. It's what everyone's talking about. What's the future in this industry for AI? If anyone wants to jump in on that.
Bank of America talk about that first.
We just had a very busy climate week. Some of you may have been in New York last week. That was probably one of the 4 major topics during the climate week. And we actually hosted an event with Microsoft and NVIDIA and some green energy developers to talk about really 2 things. One is, clearly you heard, whether it's 50 gigawatt or 100 gigawatt, Gen AI is going to consume a lot of power. Right? GPUs just consume so much more power than CPUs. How do we deal with that? So it's not just the brick and mortar construction of the data center, it's really the power consumption that worries people. However, on the other side, AI does actually provide a lot of promise. And some of the most promising things that, we actually had a Department of Energy, the US government moderate 4 private sector panelists, which you can actually see the dynamics there in the US. But what's very interesting is, these promising cases like battery chemistry, Microsoft was talking about using AI to actually start looking at battery chemistry and going from 32 million combinations to 12. And then the best winner of the future of the battery technology uses 70% less lithium and is 45% more efficient than the lithium-ion battery. Of course, it's still in the lab, right? But the national lab of the US Department of Energy is collaborating with Microsoft and others and the academia to actually kind of derive these technologies that's slightly less reliant on certain critical minerals and potentially less supply chain impact. So that's one, right? So in terms of all the technologies and the products and the mineral usage and supply chain, lack of supply chain reliance. The other is really using AI to predict renewable energy generation better and distribute the power better and think about peaks and non-peaks and how do we do that better. And then the other thing was super, super interesting was to do the resilience and adaptation effort, which is obviously where there's no business case. There's no money to be made there. But we have to do it because otherwise we'll spend so much more money on disaster relief than prevention. That you can actually predict better. It's from weather patterns, damage prediction. Now you can be more targeted, right? And be more efficient in spending your dollars in building against potential disasters. So those are some of the examples. So I do think it's sort of a double-edged sword. It's gonna probably get worse before it gets better. We'll use a lot of power. I mean, people are talking about gas coming back and what have you, because renewable energy alone probably won't satisfy that 100 gigawatt additional demand by 2030. But at the same time, if we can do it right, and we actually will see a lot of benefit on the application side.
That's fascinating. Right, we have a few minutes to take questions from the floor. This gentleman here was first with his hand up.
Hi there, and thanks to the panel. That's been really interesting. My name is Gerard Casey. I'm the CEO of Cantor Fitzgerald in Ireland. We oversee roughly 9 billion euros of assets for domestic clients, with over 1 billion of that in sustainable and impact strategies. But what we see is a huge disconnect between our institutional and corporate customers and our retail/individual customers, where the demand, frankly, from average investors has waned over the last year or so with higher interest rates and higher cost of capital. My question is, has the panel seen innovative or smart ways in other geographies where retail investors are truly encouraged to invest with impact in mind, whether it be tax incentives or regulation?
I haven't seen the tax incentives specifically in place. I'm from Estonia, but we keep an eye on Scandinavia. Scandinavia also a lot drives these changes. But what we see in Scandinavia specifically is that the retail customer behavior, daily behavior, is very much supported by the government on thinking about sustainable food, sustainable way of commuting, sustainable way of travel, all the clothing, all this manufacturing, housing. In Estonia, for example, all the new schools and the buildings, constructions are zero energy houses, so it's coming. But on the government level, pushing retail investors to invest sustainably, this has not been introduced, in my mind, in any of the countries. It starts from institutionals, though, as you mentioned, from pension funds, but not from the retail ones.
I would say that's a great question.
Yes.
And I think we actually observe the same in the United States. And the reason largely is because retail investors, when you think about the most often, utilized vehicles, mutual funds or CCAPs or, whatever you call it here, these are targeted and listed public companies, right? Whether it's a debt fund or equity fund and what have you. As you know, unless you're talking about renewable energy, mutual fund or EV, as you know, some of these performance hasn't really been sort of straight up in terms of very, very outperformance, consistent outperformance. So retail investors, because the tools are slightly limited and because of the protection that's being put in place for retail investors, public markets is where they typically go. And there's no pure expression except for these pure play companies and portfolios and baskets of them. So it hasn't been performing, given everything we just talked about, challenges and supply chain, what have you, performance hasn't really been stellar. So you're gonna see less inflows. But when we think about a little bit more blend between public and private, because a lot of the energy transition and the sustainable development is happening in private markets. And before, whether the company themselves get listed and become a public company, or the projects themselves actually get into a securitization market. So the private market is, frankly, a lot of this trillions of dollars of this action is happening, as well as on public companies' balance sheet, but it's kind of mixing this very large portfolio. It's not a pure expression. So I think it's a little bit tricky, but institutional investors, whether it's a pension fund or insurance companies, asset managers, they have asset allocation. They can actually start to play in addition to public markets in the private, in infrastructure, in real assets, in real estate as well, when they think about green data centers, for example. So it's just a little bit more, I would say, frankly, more straightforward for institutional investors. But once the market develops to a point where more things like solar plus storage becomes break even and more commercial, you're going to see that potentially getting into more public markets and become much more structurally sound and available for retail investors.
And the issue is probably a generational issue as well. The boomers are the guys with the investment monies to invest, and they don't get the sustainability agenda as much as our 20
Do you
and 30-year-olds.
call them boomers in Ireland too?
Yeah, they're here as well, I'm afraid, yeah. And that's a big issue, let's say, in the ESB, where we're trying to get more people to invest in electric vehicles, more people to put in heat pumps, more people to put in solar panels. Yeah. And there's a huge educational thing to do. I mean, I think it's incumbent on government and all the people in the companies as well. We've got to start educating and supporting all our populations. The consumer issue, that this sustainability thing is not just a nice to have, it is vital for the survival of the human race, and we've got a lot more work to do there. So that issue that you're facing of the retail investors saying, I don't like that sustainability thing too much, it's not just investment that the issue is. There's a whole pile of things that our consumers will have to do differently and better and quick, and then there's a job on all of us to do that education process.
This lady here.
Thanks a lot. Really great discussion. I'm a little surprised there was a comment about carbon pricing in one of the previous panels. I mean, I think to talk about business cases, we can't not include the fact that externalities aren't priced. And that's the single thing that can be done, I think, to completely flip the business case for all of the wonderful sustainable businesses that there are and that there will be. So I think even in the budget here in Ireland this week, carbon tax, it was set to increase from €7.50 per tonne to €63.50 for heating and transport. I think the EU ETS is about €62 at the moment. It was mentioned earlier, it needs to be at least 100 euros, dollars, whichever, per tonne at least. I mean, there was a little bit of mention about direct air capture. I mean, just to think, direct air capture today costs in the region of, if I'm not mistaken, $600 to $1,000 per tonne. It's a forecast by the IEA to be between 135 to $335 in the future. I don't know when that is. Like, we're not pricing externalities. So, any comments?
That was a second hot topic during New York Climate Week, and frankly, we actually had a lot of pragmatic discussions about it, including the U.S. regulator. So we had U.S. Treasury, we had U.S. CFTC that's going to govern the voluntary carbon market futures. But I would say you're absolutely right. If we have carbon tax globally, that will be a very, very powerful silver bullet, because that will make the business case that we keep talking about much easier. Because then you will start looking at what is the true profit of this project or product or service, because you will actually factor that into it and you'll level the playing field and makes financing investments much more comparable. However, we won't have that necessarily. I mean, I don't know, maybe eventually we will. So we have to kind of make the best use of what we have. Compliance market, EUA, California, RGGI, Asia, parts of Asia, covers 33% of global emissions. And they're pretty robust, I would say. And you can see, obviously, it's a good indication when carbon prices become, very, very high versus become very low. And then there's a lot of impact from politics as well as obviously just the global implementation of climate finance. Voluntary carbon markets are growing at a very anemic pace. I think the market reached a peak in 2022 and since then fell because there was a lot of questions around integrity. But I think, long story short, there's a global movement now towards the core carbon principles, CCPs, if you have heard about it, that's going to govern, and that's why the US government and Secretary Janet Yellen all went behind it to say, now everybody should endorse CCPs, whether you're doing nature-based carbon solutions or technology-based. You mentioned GAC. You know, these are very, very expensive, but we've got to support them. And nature-based reforestation and others, and blue carbon, soil carbon, many, many different great programs. People can discern what's good, what's bad. So I do think now, after a couple of years of very anemic growth, there is some new momentum, and that was the optimism last week, that the voluntary carbon market will start having a new life. Now we have a little bit more of a globally accepted standard, and obviously that can get into SASB and can get into European disclosure rules. So you will see these two markets potentially support some of this, but you're absolutely right. In the absence of a single carbon tax, which globally the consensus is probably at least $100 a ton, we won't have a unified approach. So we have to use that. And I think credit rating agencies have to start evaluating public companies based on implied carbon cost, right? And those are the movements that will help level the playing field and on future investments.
I think we have time for one more. Let's take this gentleman over here.
Good morning. Fantastic session. My name is Mike Hayes from KPMG. I've met you before, Karen. I have a very specific question. Completely agree with the previous point about pricing of externalities, but I want to turn to something else. You mentioned EU taxonomy and other standards as you think about investments. Could you comment briefly on transition finance? Because this is probably one of the single biggest issues. Certain investors are coming under pressure because they're trying to invest in coal phase-out being a very good example, but because it has the effect of increasing their financed emissions, they're finding under their own rules or whatever other standards they're working towards, it doesn't qualify as a good investment, when in reality, these are exactly the type of investments we need if we're going to accelerate the transition, particularly around coal, but also around hard-to-abate sectors. So I suspect you're probably strongly in favor, but I would love to hear your views.
Yeah, absolutely. I think, first of all, transition finance has to be, I think, distinct from sustainable finance, the green finance aspect of it, because transition, you know, clearly needs to transition to something more green and darker green. But we do have this reality, right? When you look at the trilemma of energy security, energy affordability, and energy sustainability, I don't think we have a choice to say gas is not an option, especially given the data center needs that we just talked about. Where are you going to get this 100 gigawatt in the next 6 years? So renewables are not fully mature to address this in the short term. So I do think transition finance has a place to stay. You know, Paul is here, he's our vice chair. We're discussing transition finance taxonomy in the context of, in your direction, I see Secretary Kerry sitting there. Bank of America is one of the 7 institutions that was working with Secretary Kerry and the Indonesian government and Vietnamese government, for example, on just energy transition. And managed coal plant phase out is a big, big topic. And carbon credits, again, could play a role there to actually address the revenue gap if you shut down a coal plant 15 years early, for example. So I do think a lot of these solutions are necessary, and we need to be very pragmatic. And transition finance taxonomy is something we have to embrace because we have to address the trilemma.
Well, we're out of time, but that's a fantastic point on which to end. I've taken away from this panel so many opportunities, so many possibilities, not least investing in women because we're worth it, and the returns are there, and Ireland's a great place to invest. So please join me in thanking a wonderful panel.